What is your
Hi,
take?
Uche.
What is your take on the Tier 2 performance in the first half? I mean, I'm curious. Suddenly, analysts are saying Tier 1 banks posing stiff competition.
Morning, Uche. Well, Tier 1 banks have always posed stiff competition. You know, they dominate in terms of asset concentration, in terms of liability gathering. And, you know, in an environment like this, the key thing for most banks is the ability to maintain a competitive cost of funds and the ability to maintain, you know, efficiency. You know, for a Tier 2 player, you know, we've seen an environment where sort of broader policy in terms of monetary policy, in terms of naira stabilization, squeeze liquidity in the system and give rise to rising cost of funds as we move through the year. Now, inevitably, if you are a second-tier bank that doesn't have that breadth of funding base or doesn't have the ability to trap very cheap deposits, then that's going to squeeze your profitability, and we've seen that in the sector. The exception to that, of course, the standout exception is Diamond Bank, who is the only Tier 2 bank that has a cost of funds that is comparable to Tier 1 players, and as a result they've been able to deliver more attractive returns in terms of ROE, for instance, than most of that segment.
Now, you just talked about Diamond Bank being able to deliver some attractive ROE. What's your take in terms of the general ROE performance of the Tier 2 banking sector, of course, except Diamond Bank there? Now, a lot of the ROE assumptions we hear from analysts lie around 15% to 16%. Are you changing any of your assumptions, or do they lie around the same level? What's your take, Rele?
Well, I mean, if we look at annualized performance based on the half-year numbers, all of the Tier 2 banks that we look at are sort of 16%, between 10 and 16% annualized ROE. And most of them actually are nearer 10 than 16. So clearly the pressure on funding costs has given rise to a struggle. Now in the third quarter, I think to some extent this trend will remain, because we obviously saw, you know, a sharp rise, for instance, in the cost of interbank funding. And a general squeeze, which I think the Tier 1 banks would have been able to adjust far quicker from than the second-tier banks. So we may see pressure maintained in terms of cost of funds and net interest margin in the third quarter. But it would appear as well that the interest rate cycle is turning, and the sort of impetus, if you like, to extend loans is also growing. So depending on the segments that the Tier 2 bank is lending to, they may be able actually to begin to grow loans a bit more meaningfully. Because, you know, prime lending rates are not 30%, they are something more reasonable, which may support NIMs through to the end of the year. But Q3 is probably still going to be a little bit tough for the second-tier banks.
Well, in terms of your outlook, Q3, let's talk about the market performance of Tier 2 banks. What is your looking at the investment case for those Tier 2 banks? What is your take? Are they still, besides Diamond Bank? I know Diamond Bank will definitely be in the top investment list. What is your take?
Well, I think, you know, Diamond Bank has already performed rather well this year, significantly better than any of the others. I think, you know, around 60% year to date it's done, give or take. Whereas, you know, the sort of Skies and FCMBs, Fidelity, on the whole have done much less. I think the way to look at these banks, you know, one part of the equation is you know, the cost of funding and the ability to maintain margins, but the other critical thing is the cost of risk and the asset quality. Now, given the cycle that we're in and the fact that we have just come out of a sort of a major sector overhaul, which of course we've all discussed extensively, we should be in a season of much lower provisioning. We put out a report, you know, earlier this week saying that, you know, there's a challenge with you know, relying on interims versus full-year performance, because banks typically tend to disappoint in Q4 with regard to provisioning. But whilst we still expect to see that trend maintained, we think that the impact of it is going to be less. So in terms of nasty surprises in Q4, that should be contained, which will mean that based on where some of these second-tier banks are trading, at least from a dividend yield perspective, they are sort of beginning to look, you know, very attractive. And that's the way I think that investors need to look at it, notwithstanding the liquidity is lower.